afternoon, everyone. I'm very pleased to be here. Thank you to IDC for inviting me. IDC is a very important partner for Equitable and, from my perspective, a very valuable partner for you as advisors. Particular thanks, of course, to all of you who are participating today for taking the time to join in. And thank you in advance for your attention and your engagement. For those of you who support Equitable, thank you for your business. For those of you who haven't had the chance yet, thanks for considering Equitable. Now, I know many of you have lots of experience and knowledge from what I'm going to share today. I hope you're going to find some helpful information about the new capital gains inclusion regime that took effect in June, how it impacts the planning that you do with clients, and where your opportunities are. I believe we also have some Equitable wholesalers on the call. They are, of course, your first point of contact when you're looking to connect with Equitable. And finally, just before we get started, my expertise is in insurance. I'm not a tax or legal expert, but I will provide comments based on my experience and provide some high-level summaries. Now, as many of you will know, this legislation hasn't passed yet, but is expected to. There's some speculation that it might not. The spin was that this was to promote fairness in the tax system and that it only affects 0.13% of Canadians. Now, I don't know how that was determined, but it feels to me like it will affect more when you consider at least cottages and second property owners. The good news is there's no impact on how the CDA works for private companies. So I've got 30 minutes or less, I guess, now. Let's get started. Here are the topics that I'm going to discuss. I'm going to start off with some language that you could consider using for conversations about preserving clients' wealth. And then an overview of the assets that are subject to capital gains. I'm going to go through, just at a high level, some of the proposals that affect us in the work that we do. I'll go through two examples to demonstrate how the new math works. One will be personal and one will be corporate. And it will show how life insurance can be used to pay the new taxes compared to other options. And then finally, I'll finish off with where I see your opportunities in this new regime. So hopefully that sounds reasonable. Now, before we get to the meat of the presentation, I wanted to share with you some tidbits. Some of them made me think, some of them made me laugh. In Sweden, blood donors get a text when their blood is used. 25% of all the bones in your body are in your feet. The Mona Lisa has no eyelashes or eyebrows. And finally, the cost to build the ship Titanic was $7 million. The cost to make the movie Titanic was $200 million. I think the most expensive movie at its time. All right. So as I mentioned, I want to start off with some ideas about conversations you can have with clients about preserving their wealth. There was a study done recently, and another study that actually corroborated this, that surveyed high net worth Canadians, defined as Canadians that had $1 million of investable assets or more. And we could argue whether that's high net worth or not, but nonetheless, they were the subject of the study. They were asked many questions as part of the study, of course. One of them was, what's your knowledge of estate planning? 75% of them said it was nothing or very little. Another question asked what their number one priority, what their number one objective would be from a financial planning process. And 66% of them said preserving their wealth. And the second most popular number one priority was actually fairly further down in terms of popularity. So we know that high net worth Canadians are very interested in preserving their wealth, but they haven't been exposed to ways to do that. And this survey also found that the reason they haven't been exposed is they're often dealing with trusted advisors who don't work in the estate planning space. That might be tax advisors or investment advisors. So here's some thoughts about language you can use to start this conversation and uncover some attitudes from your clients and prospects about preserving their wealth. What's important to you about the wealth you've created? Is it enjoying it yourself now, preserving it for your family, giving back to the community or causes that are important to you, or is it minimizing, even avoiding taxes? Is your legacy important to you? Do you want to preserve that for your family, for instance? And how much will be preserved? You may find, as I do, when you ask a question about erosion of a state or preservation of an estate, oftentimes people overestimate how much of their wealth will be preserved. And that's because they underestimate the impact of taxes. Now, with this new capital gains inclusion rate regime, the conversation's happening more, but I still find people don't understand the impact of taxes. So another good question is, at death, what will be the tax impact on your estate? Have you calculated that? And how will those taxes be paid? And what is the most efficient way to transfer your wealth to your beneficiaries? Let's just talk briefly about the types of assets that are subject to capital gains. So, of course, equity investments, where there's a capital gain locked into the investment, that would be a stock or a mutual fund, seg fund, or exchange traded funds. Bonds, to the extent that they're sold prior to maturity. A family cottage. Real estate other than the primary residence, so second, maybe investment properties, for instance. And of course, the shares of a private corporation. Now, I want to remind you, this will be maybe common knowledge to some of you, that you are deemed to dispose of all of your assets at the time of death. Doesn't mean that they're actually sold or disposed of, but you're deemed to dispose of them. So any asset that has an accrued capital gain, that capital gain will be triggered and capital gains tax will be due. To the extent that there's a surviving spouse, assets can be rolled tax-free to the surviving spouse, and then at his or her death, the taxes will be due. There'll be a deemed disposition at that time. All right, so let's just briefly have a look at the proposals. I'm sure a lot of you will have digested this, so this will be a review. Maybe it'll be a slightly different perspective that I can offer. Let's start with the capital gains inclusion rate and the lifetime capital gains exemption. For any gains realized on or after June 24, 2024, the new capital gains inclusion rate regime will apply. The new rate has moved from 50% to 2/3. And by the way, there's been lots of spins on what this increase represents, but in Ontario, it represents an increase in the amount of tax you're paying of almost 9%. So by my math, that's a 33% increase in tax. Now, for individuals, there is a break on the first 250,000 rather of capital gain realized in every year. That will be an inclusion rate of 50%. Anything above 250,000 is 2/3. I'm calling this a graduated inclusion rate. Now, tax integration is not perfect anymore because that 50% on the first 250,000 does not apply to corporations or trusts. The lifetime capital gains exemption increases from just over $1 million to $1.25 million. And then indexing of that $1.25 million starts in 2026. Now, I would say to you that it's substantial. If you look at the amount of tax savings that results from that exemption, depending on whether or not you include the 250,000 at 50% inclusion rate, it's 420,000 or more of tax savings if we look at the highest marginal tax rate in Ontario. The second proposal that I want to review, and the last that I'm going to review, is what's called the Canadian Entrepreneurs Incentive. It's effective starting in January next year. And for capital gain up to $2 million in a lifetime, the inclusion rate, if you qualify, will be half. So it'll be 1/3. That $2 million is actually being introduced over the next 10 years in $200,000 increments. So it'll be 10 years before we reach that $2 million lifetime limit. And this CEI will be on top of that, is in addition to the lifetime capital gains exemption. But there are some fairly complicated qualification criteria, and I've highlighted a couple here. I'll go through them quickly. It's available for people who start a business, that is, founders. So if you've purchased a business from a founder, it's not available. And the person who owns the shares and wants to claim the incentive has to have been working in the business for the past 5 years and been actively engaged in the business. And also, the share cannot be of a professional corporation or a business that carries on particular activities, and I've highlighted operating a financial or a real estate business. And they also have to qualify under the asset tests for the lifetime capital gains exemption, which, as many of you will know, no more than 10% of the assets in the business could not be passive, like investment assets, at the time of disposition. So for us, that would be at the time of death. And for 2 years prior to disposition or death, no more than 50% of the assets could be passive assets. All right. What I'd like to do now is just pivot and talk about two situations with some calculations in the new capital gains inclusion rate regime. And I'm going to use two examples. One is personal and one is corporate. The personal is a family cottage, and the corporate is shares, as you might imagine, of a private business. For the cottage example, I've chosen two people age 60 with highest marginal tax rate in Ontario, cottage fair market value of $800,000, and they've got an adjusted cost base of $350,000, which would include the original purchase price, plus they've been able to record investments, improvements they've made in the cottage over time. So the capital gain today would be $450,000. If we do the taxable capital gain calculation, the first $250,000 at 50% would mean the taxable capital gain on that amount is $125,000. The remainder at 2/3 is $133,000. So we have $258,000 taxable capital gain, which means tax of $138,000 at the Ontario highest marginal tax rate. And that's compared to $120,000 under the previous regime. Let's project this forward. Now, I know, particularly in Ontario, cottage prices went crazy during COVID. I'm just going to grow this cottage at 4% over 25 years. This is a family cottage. Let's assume that at their age 85, they've both passed away, and it's going to pass on to the next generation, and they want to keep it in the family. At 4% growth, it's $2.1 million. So that means a capital gain of 1.7. And if we do the tiered calculation, it ends up with 1.14 of taxable capital gain and a tax of $613,000. Again, compared to the old regime, that would have been $477,000. So today, $138,000, 25 years, $613. What's the best way to come up with the tax, to come up with rather the funds to pay the tax in 25 years if we want to keep that cottage in the family and not have to sell it in order to pay the tax? Well, I'm going to suggest there's a few ways to make sure the money's available. We could start saving today in a sinking fund and put money away every year for 25 years. That's a bit of a gamble because we don't know when death will occur, and we have to assume a rate of return. In this case, I just assume for simplicity a fixed income investment earning 5%. That means just under $18,000 per year for 25 years. If we wanted to do it in one lump sum, that would be $345,000 into that same investment. If we were to borrow at the time the tax was due, provided a lender would lend to the estate, we could take out the loan at the time, 25 years down the road. I've assumed 7% interest cost and an amortization over 10 years. That means $102,000 of loan payments. Or we could use a life insurance solution. And in this particular situation, I chose an Equitable Equimax Par whole life policy, life pay, joint last to die, starting out at $353,000. $9,700 is the annual payment. Now we're dealing with cash flows at different times here, so we have to compare them all in order to be fair at one point in time. So I'm going to do it in today's dollars, and I'm going to use a time value of money of 3%. Lots of disclaimer on this slide. I guess what I want you to do is focus on the graph. The graph shows that cost in today's dollars of each of those options. The gold is that sinking fund putting away money every year. The blue is that lump sum. The red is borrowing, so we've got the interest cost. It's the most expensive. And the teal is the life insurance. It's the least expensive option. Let's then pivot to our corporate example. Got the same male age 60. I'm going to use a joint last to die in this situation as well. It's going to be $5 million fair market value on their shares with a zero ACB. And let's assume there's been an estate freeze and there's preferred shares. They're fixed value and therefore fixed capital gain of $5 million. We'll assume that in this case, the capital gains exemption is going to be used from the primary business owner here of $1.25 million. And we'll just ignore the Canadian Entrepreneurs Incentive, assuming that for whatever reason they don't qualify, just for this example. So if we think about the capital gains tax liability, knowing that they're fixed value preferred shares, after the exemption, it's $3.75 million. If we do the tiered calculation, we get a taxable capital gain of 2.4, resulting in tax of 1.3. So let's look at these strategies, but let's assume we're using corporate dollars to create the funds that are needed to be distributed to the estate and pay any shareholder level dividend tax that must be paid to do that in order to cover the taxes that will be due. So we could start saving today. For 25 years, you'd have to put away $61,000. If it's a lump sum, it's just over $1 million. If we're borrowing, we have to borrow more than the tax liability because, again, we have to distribute it out of the corporation and pay that shareholder dividend tax in order to result in a net amount to pay the tax in the estate. That means that we'd have to have a payment of $358,000 for 10 years at a 7% loan rate. And then for this example, I just decided to use a minimum funded UL policy for an amount of death benefit that would result in a net of $1.3 million to the estate in order to cover those taxes. And that means an annual premium of $23,000. Again, I'm using a time value money of 3%. And in today's dollars, here are the costs for each of those options. The gold is a sinking fund with annual payments. The blue is the lump sum. The red, of course, is borrowing. It's most expensive. And the teal represents the cost in today's dollars of the insurance. So why life insurance? To cover off this increased tax liability that folks will have on any assets that have accrued capital gains. Well, first of all, it creates liquidity at the time of death, where other solutions to fund taxes may not. There's a timely settlement. It's just a matter of settling the claim and paying it to the beneficiary, being either a personal beneficiary, the estate, or a corporation. And of course, it provides the funds exactly when they're needed. That is, at death, when the taxes are due. And as we've just seen, it's the most efficient way to pay for those taxes compared to saving or borrowing. So here's where I see your opportunities in this new regime. First of all, review existing plans that assumed a 50% capital gains inclusion rate, because now there'll be more capital gains tax and maybe more insurance. Ensure that clients get advice on proper structuring to take advantage of the exemptions, because the lifetime capital gains exemption and the CEI are available to individuals on shares they own individually. So they need to make sure that they do own enough shares individually to be able to absorb those exemptions. And they also have to pay attention to the qualifications, particularly those ones that I outlined for the CEI and the asset tests for the lifetime capital gains exemption and the CEI. And point out to clients what the tax bite will be. And maybe that means getting their tax advisor involved to do the calculations. And point out that there's now an increased need for liquidity in their estate. And we're happy to help you go through an example that you might have, a case that you might have, and produce those graphs that I showed you earlier on for your particular situation. Now, I will say one last final comment. I've done a little bit of math, and I've found that the break-even point is 6.25 million, where the current regime with the 2/3 inclusion rate pays less tax than the previous regime if you consider the lifetime capital gains exemption and the CEI, as well as that 50% inclusion rate for the first 250,000. So that's it. Hopefully that was for some of you, a reminder of what's happened and what the new proposals are, and how insurance can be such an effective way to cover this increased tax liability. If you're working on cases that you'd like some help with, or just a second pair of eyes, or you're intrigued by what I showed you with the comparison of the different options, please reach out to your wholesaler at Equitable. We'd be happy to help you.
Again, Matt, as usual, that was fantastic. So if you want to stop sharing your screen there now. Great to have you here. Congratulations on joining Equitable Life. It's been a while now.
Yeah, it's been a little over a year.
Yeah, so you've settled in, you're getting ready to work, and we'll use you this fall and into the spring. So fantastic.
Great time. Thank you to you. Thank you to IDC. And of course, thank you to everyone on the line. Really appreciate the time.